welcome to another week of Mortgage Minute. I am Matt Thomas, a local real estate agent, and this is Brian Dewald, a local mortgage lender, and Brian is with the Dewald team at Fairway Independent Mortgage. And Brian, as we do every week, we are here basically to dispel some myths and some rumors about what's going on in the mortgage world. Wanted to keep people apprised of, the changes and it's not necessarily to say exactly what rates are, but maybe where rates are, what they're doing, what's affecting rates, how that's affecting the housing market ultimately. So, and we encourage you all, of course, if you're watching, to subscribe and stay tuned because things change so quickly. So, Brian, right now I've just noticed in August the doom and gloom headlines, if you will, and you and I both know that the mortgage world and the real estate world is not necessarily operating the same way as headlines would tell us, lead us to believe. And in fact, even when you click on these articles, when you read about it, it tends to be something that's not what's actually you're being led to believe in the headline. Brian, I guess I should say, first of all, welcome. How are you doing this morning?
Good, man. Thanks for having me.
Great, man. Well, I wanted to just jump into it. Let's talk kind of about what rates are doing. We haven't met in 2 weeks, so why don't you give us an update on kind of what's happened in the last couple of weeks with rates and where they're going, where they're headed.
Yep, for sure. So the age-old question is always where are they headed, right? And that's just who knows. I sent somebody kind of a smart aleck deal the other day and says, what's your outlook look like for the fall in terms of mortgage rates, and I sent a crystal ball. Yeah, there you go. That's perfect. Yeah. Shake it up real good. Let's see what it looks like for right. October, November, December.
No idea.
Right. But the last couple of weeks has been a little interesting. The Fed chairman Powell spoke on Friday of last week, and it kind of freaked the markets out, to be honest with you. There's another. I can't remember exactly what her role is, but the Fed head in, I believe it was Cleveland, it's a woman, and she repeated the word pain over and over and over, in her recent talk and as well as Powell's talk last Friday. So the combination of those two things, like I said, it kind of freaked out markets a little bit. We've seen a little bit of an uptick here in terms of mortgage rates over the past couple weeks, not necessarily related to that, but that certainly didn't help anything either. So, the combination of that, we're seeing a little bit, interestingly, some kind of neat job report things that may not be awesome for mortgage rates, but I feel like it's awesome potentially for just the general well-being of the public and homeowners and everybody else. So
yeah, you had alluded to that. So that's what's interesting. That the economy is doing some interesting things. I mean, you've got what Powell said and the market's reaction to that, but you've also got in relation to the job market, there are lots of jobs still being created. It has been, that number has declined in the last couple of months, as I think you told me before we jumped on this call. But on the other hand, it's still going up. There's still job improvements. Now, Brian, you'd also mentioned some other really cool things that related to
just income stats.
Income. There we go. The income. So why don't you tell us what you learned about income?
So there's a relatively new group that's being thrown into the unemployment or the employment world, either way we look at it. A lot of folks have heard of the company ADP. They're a payroll company, and they are collecting data for, employees and workers and figuring out kind of what numbers look like. And what they've found recently, so they've looked at the amount of new jobs that have been created. And we went from, I think it was 380 in June to 270 in July and down to 180 something in August. So we're seeing less and less new jobs. But here's what's interesting, and this is going to have a big role in housing, in my opinion, is that folks are earning quite a bit more than they've done in the past. So people that have their current job, same job that they've had for a year, are earning about 8% more than they were a year ago. And then folks that are moving companies are earning about 16% more than they were when they left their old company. So that tells us that a lot of people are not struggling to make mortgage payments, right? When we saw the last housing bust back in 2008, it was primarily because people couldn't afford to make their payments. It didn't have a whole lot to do with market situation at that point. Of course, the market fell, but it was due to a lot of it was due to folks not being able to afford their home payment. So, the fact that a lot of people refinanced over the last couple of years, their payments are low, their incomes are up. I think that's going to have a big role in what we see in future market stuff as far as prices and stuff like that.
Well, in projecting forward, you can see where that might lead to. You can see that leading to maybe maybe less people list their homes this fall, right? And so maybe even with mortgage rates being up, the demand is down. So if you've got demand that's down, you've got inventory that's down, because we don't necessarily see everyone putting their house on the market. And that might be the case if everyone was losing jobs and that kind of thing. But if the inventory remains low, then we have, we've got supply and demand actually kind of leveling each other out, and therefore prices potentially stabilize. So there's a lot of thought out there on what home prices will do and how mortgage rates will continue to affect that. You mentioned, when you have job increases, sometimes that actually points to a non-recession. Now, there's been debate about whether or not we're even in a recession. I look around and I still see people, it looks like, spending and doing things. And so, who knows, right? But there are a lot of dynamic factors with the economy, of course. And those are all things that potentially can have an impact on mortgage rates and housing. Brian, there was also an example that you had put together on affordability. Now, so you mentioned affordability from an income standpoint. What about just from, if you compare things to, the market was hot, let's say last February, in March, right? And people were having to pay, let's say for a $500,000 home, they were having to pay maybe $100,000 over just to be able to get it, right? And how does that compare now to, if somebody were to buy a home currently with higher interest rates?
Sure. So I did just a quick affordability check, and there's a million different factors that go into exact specifics. But for just a plain example, I used a $600,000 purchase price, which would have been kind of a good average back in February. And I looked at a $500,000 purchase price today, which is a decent average, right? Medium home price, somewhere in that ballpark. So with rates being where they were and where they are now, there's about a $200 a month difference between where they are now and where they were then. So it was a little more advantageous then. The one thing that we can't factor in, at least on a short video call here, is, like emptying our bank account to be able to do it, right? And, potentially guaranteeing appraisal and all of these kind of crazy factors. But just in the raw nuts and bolts of 600 versus 500 in rates then and now, it's about a $200 a month higher payment now than it was back then. So, we look at another 8% or whatever it was, an increase. A lot of times that can help offset some of that stuff. So anyway, that's about what I came up with.
Yeah, no, that's very helpful. So, it does show that things are a little bit more expensive now. But to your point, if people are, making 8% more, on average per year, maybe that, there's some affordability there that's actually still in range. If they're getting a new job and they're making 16% more per year, that, that $200 maybe doesn't feel nearly as high. So again, it's going to keep some people out of the market, but some people certainly are going to keep pushing forward, especially if they're getting new jobs. If they've got upward mobility, they're making more money. They feel like they may want to increase their home. They might feel things right now. People have more. We've talked about it several calls in the past. There's more to choose from. There's more opportunity to negotiate with sellers. And we've talked about also, asking for rate buy downs, which is a great way to help for sellers to be able to incentivize a buyer to buy their home. And a buyer feels like they can, get down to a place where homes are a lot more affordable. I mean, if you add in that with the other things we've talked about, you might actually be, you might possibly with a rate buy down. Do you think you could relieve that $200 difference?
Absolutely. Yes.
Yeah. So again, lots of opportunities. And then the point is that, in any market, there are always opportunities. There are always, advantages and disadvantages, right? And so we're just pointing out what's going on and what's trying to be real about it. All right, Brian. Well, appreciate the information and appreciate your time. As always, again, we're going to encourage you to not only subscribe, but also please do reach out. If you want to discuss your situation, we obviously know everyone's situation is unique. So we'd love to have you reach out to Brian related to mortgages. Reach out to myself if you want to talk housing market. We're both open for a consultation, and you can certainly reach us. Just kind of get the ball rolling, or even just to have a conversation. If you're 3, 5, 6 months out, a year out, there's always things. Sometimes Brian can help you get things rolling from improving your credit situation. Well in advance of a home purchase. So, all right. Well, until next week, appreciate your time, Brian. Thank you.
Good to see you.